Hi there. Let's talk about PBF Energy. PBF is a huge independent U.S. petroleum refiner, and it has both a debt problem and a cost problem on its hand. When I say an independent petroleum refiner, when you think about petroleum refining, you might think of ExxonMobil or you might think of Chevron. And these are integrated oil companies that pull oil and gas out of the ground on the upstream side, send oil and gas all around the country between the wells and refineries in the midstream space. They could refine the oil into gasoline and diesel and jet fuel and all the rest on the refining side, and then get it out to retail gas stations where you might put it inside your car, all on the downstream side. So Exxon and Chevron are integrated oil and gas companies, whereas PBF is an independent refiner. Other independent refiners are Valero and Phillips 66 and Marathon Petroleum. And so when we look at the world of independent petroleum refiners, we see some pretty interesting scale issues here. So across the United States, we refine about 18 million barrels per day of crude oil. And Valero and Marathon both have about 3 million barrels per day of capacity. And Phillips 66 has around 2 million barrels a day of capacity. PBF has right at 1 million barrels a day of capacity. So when you take those big four independent refiners, you get to 9 million barrels a day of crude oil refining capacity, which is nominally half of the activity that happens inside the United States. So these independent refiners are big, and they represent a meaningful fraction of the refining activity that occurs inside the United States day to day. So what PBF does matters. It absolutely has an impact on the U.S. energy footprint on the whole, and that's one big reason why they're worth talking about. I mentioned that PBF has a debt challenge on its hands, and I sometimes say that PBF is the Occidental of the refining space. And if you haven't heard, Occidental is a big upstream oil and gas company in the U.S. And they're interesting for a bunch of different reasons. One is their stock price has boomed so far in 2022. They're in fact the best performing S&P 500 stock, or at least were as of a handful of days ago. Warren Buffett is a massive shareholder of Oxy, and he recently got permission to buy up to half of the company. Oxy also has a female CEO named Vicki Hollub, and she was the first female CEO of any U.S. major oil and gas company. So Oxy gets a lot of attention. And Oxy is interesting also because it was one of the most distressed, probably the most distressed upstream oil company in the U.S. as we went through the pandemic. Oxy had a massive debt load on its hand just as the oil and gas landscape was crumbling around it. Oxy had such a heavy debt load because they had recently, I think back in 2019, acquired Anadarko Petroleum, which was itself a massive upstream oil and gas company. So Oxy completes that acquisition and goes into the pandemic and just takes it in the shorts. They had a real tough time through the pandemic. Well, PBF had similar challenges, just on a much smaller scale. PBF had just acquired a big refinery going into the pandemic. PBF's debt load had gone from about $2.1 billion a year before the pandemic to something like $4.7 billion as they're entering the pandemic. So during the pandemic, when oil prices go negative for a day in April and everyone's financial performance is just cratering, the debt isn't going anywhere, right? The debt's still sitting there. These companies still owe all this money to all their creditors. And there were real concerns during the pandemic about whether PBF would survive and whether they'd be able to generate enough cash to even service this debt and what it would look like on the back end if PBF couldn't make things work. So PBF got a lot of attention during the pandemic, much like Oxy did, because those waters, while turbulent for everyone, were even more turbulent for PBF. So PBF navigated through the pandemic. They're still around today, still doing all their refining, but they still have this debt issue that they're dealing with. And I want to talk a little bit about what they're trying to do to combat those debt issues. PBF has an interesting origin story. It was formed in 2008, and its remit was basically to go acquire downstream oil and gas assets, which basically means refineries. They were looking to buy refineries that other companies were willing to sell and discard and get rid of. And they've executed that strategy more or less precisely the way that they had anticipated. PBF today operates 6 refineries, and they've bought 2 of those from Valero. They bought 2 of those from ExxonMobil. They bought 1 each from Sunoco and from Shell. And the Shell refinery they bought was the Martinez refinery out in California. I'd mentioned they bought a refinery right as the pandemic was setting in. That was it. They closed on the Martinez acquisition in February of 2020 and spent $960 million to buy that refinery. Literally, a month before the lockdowns swept across the United States. So that has been PBF's strategy, and it might sound sort of boring and benign. It's a pretty bold strategy because you're taking refineries off the hands of someone like Valero or ExxonMobil. I mean, these are premier operators that think very deeply about which refineries are core to their portfolio and which ones they're going to bet on long term. And Valero and ExxonMobil decides, no, these refineries that we're going to sell to PBF are not the kinds of facilities that we want in our portfolio long term. They're not the ones that, if we only have a certain number of investment dollars, we'd rather steer them toward these other refineries and not toward the ones that we're selling over to PBF. So it's pretty bold. It's a pretty contrarian take to line up on the other side of these transactions from these major refiners. And again, timing did not work out in PBF's case, particularly on the Martinez side, taking on that refinery just as the pandemic sets in and just as oil and gas prices crash and the financial prospects for everyone in the oil and gas industry more or less go up in smoke, at least in the short term. That's when PBF hands out $1 billion and grabs hold of this asset. So PBF has an interesting origin story, and there's a reason why they've ended up being the most distressed of the refiners. Their credit rating is still in the sort of highly speculative range, which means there's material risk that PBF is not able to service and ultimately retire all of its debt. PBF, of course, is aware of this, and as a result, today, when oil and gas prices are much better than they were certainly during the pandemic, but even leading into the pandemic, PBF is running all of its facilities at full bore. It's just trying to generate every penny of cash it possibly can because it knows it has use for it. It has this mountain of debt, even though it's retired, I think over $2 billion of debt within the past year. There's still a mountain of debt out there for it to go tackle. So it knows it needs every penny of cash it can generate to go fight against this mountain of debt. And like I said, that's why they're running their facilities at breakneck speeds. They're breaking, in Q1 and Q2 of 2022, they've set corporate production records for each of those quarters for years and years into the past, and possibly could be for the whole history of the company. They've set these records. So it's makes sense because they're trying again to generate cash while prices are so high and the opportunity is so strong. The challenge is they're running at breakneck speeds, and that's risky because it means these assets are more likely to struggle. They're more likely to break down. You're more likely to pull forward maintenance events that otherwise you could have pushed out. And like any machine, when you stress it that much, you end up walking a tightrope trying to get it to run routinely and reliably. And that's a huge concern for PBF at the moment, again, given its obligations to creditors. We've talked about how oil and gas prices are higher right now than they've been historically, and as a result, PBF is just ramping up production as quickly as it can. So that's great because revenue for PBF is way up, profitability for PBF is way up, but costs are also way up, and that's something I want to look at right here. We have a comparison that we need to make between Valero, Phillips 66, and PBF. And what we're going to look at is a bucket of costs that they call operating costs. For any refinery, the single largest cost by a mile is the cost of crude oil. It's the cost of the crude oil that they buy to bring into the facility that they then turn around and create gasoline, diesel, jet fuel, all these other exotic finished products on the back end. So the cost of crude is the dominant cost. That's not something that refiners generally have much control over quarter to quarter. So I like to pull that cost out when I'm doing some of these deep dives and focus instead on what's labeled operating costs. Operating costs for a refiner, there's a bunch of stuff that goes in here. You're typically talking about the compensation costs for the plant workers themselves. You're talking about the cost of energy that you need to actually process the crude oil and turn it into the finished products on the back end. You're talking about the costs of inspecting, repairing, maintaining all the equipment in the facility. You're also talking about the costs for third-party service providers. You generally have folks come into the plant to do all kinds of work that your full-time employees aren't going to do themselves. And that's a big bucket of cost that lands inside of this operating cost umbrella. And then there's some miscellaneous costs that go in here as well. These are costs that operators do have a little more control over. They might not control, say, the cost of energy specifically, but they have some control over where and how they use energy and what sort of products they want to create on the back end. And so there's a little more discretion and control that refiners have when it comes to managing costs inside of the operating cost bucket as compared to the cost of crude itself. So we can look at this chart here, which shows how operating costs have evolved, again, for Valero, Phillips 66, PBF over time. And you're looking at back in, say, 2016, we're looking at costs. So you see Valero is the low-cost operator throughout time here. And Valero starts out with a cost of around $4 per barrel. And we see Phillips 66 and PBF is being nominally $1, $1.50, sometimes up to $2 higher than Valero. And this cost advantage that Valero has is consistent over these number of years. But costs have been trending up for all of these refiners. And what that shows is there's real opportunity here for Phillips 66 and for PBF to capture some of this cost difference. There's no reason they should structurally be as far behind Valero as they are. There are sometimes some reasons why one refiner may have a bit of cost advantage over another, but when you get to $1 a barrel and higher, these are very large gaps. It shows there's real opportunities for Phillips 66, for PBF to run these facilities more effectively and mitigate some of these costs in a way to bring that delta down. And again, both of these refiners are so large. Their capacities are so large, the throughput levels are so high that even when you get down to fractions of $1 per barrel, you're talking real dollars at stake here. For instance, if PBF was able to cut their operating costs only by 25 cents a barrel, right, which is no more than a fourth of the gap that they're facing with Valero, and even smaller than that, that can generate quarterly savings over $20 million. And that's getting you toward annual savings of around $100 million. And again, those are just cost savings. That's not running the facility more often, which can generate tons of extra revenue, extra profit. It's not changing the slate of finished products you have on the back end, which can have big time impacts on your financial performance. If you produce a larger volume of higher value outputs, then that can make a big difference. We're not talking about any of that. We're just talking about managing these handful of costs that live inside the operating cost bucket. And if PBF does it the right way, there's basically, on a conservative level, around $100 million a year of savings. And that number absolutely matters. It matters to PBF's management team, and it matters to the investors that are deciding whether to buy or sell or hold their shares in PBF stock. I want to put a little context around these cost increase numbers here. Since the beginning of 2016, the Consumer Price Index, a popular measure of inflation in the U.S., has grown at 3.5% compound annual growth rate, CAGR, a 3.5% CAGR. Valero's costs in this chart are growing at 5.5% annually. Phillips 66 is at 7.1% growth annually in operating costs. PBF is at 8.3% annual growth. So all these numbers, even the Valero numbers, are all in excess of CPI. They're all in excess of what inflation alone would have suggested should happen to these costs. So it's a point that I want to make, that it's easy to focus on the fact that oil and gas prices are higher. So as a result, revenues are higher for a lot of these refiners and the companies in the broader oil and gas space. Profits are higher for these companies, but costs are also higher. And costs have grown very aggressively. And like I'd mentioned, PBF has tens of millions of dollars of annual savings opportunities here to go capture. And it might sound kind of boring, but there's some simple ways to go after this. And I'll explain them very quickly. But first, I should explain, I'm the Chief Strategy Officer at an industrial reliability services company just outside of Houston, Texas, called Pinnacle. And we work with these big refiners every day to help them inspect and maintain and repair their equipment more effectively. We help them come up with plans that they can use to know what they should be inspecting and how, and what sort of maintenance events and interventions matter the most. And it sounds mundane, but doing that kind of work the right way can save these big refiners tens of millions of dollars, sometimes $100 million or more in annual costs. So it can be as simple as just being very intentional and deliberate and data-driven about how you execute these reliability programs. Today, the way that refining has worked largely in reliability for the past 20 years or more at this point is you have just an alphabet soup of programs that you go after. You do some reliability-centered maintenance, RCM. You do some failure modes and effects analysis, FMEA. You set up a risk-based inspection program, RBI. When something fails, you perform a root cause analysis, RCA. And so you have this alphabet soup of tools that you use them in different ways and different facilities, and different team members are involved with them. Some of them you're running internally, some of them you're bringing in a consultant to help you run, and you're just doing it on an ad hoc basis. And a lot of these tools just involve some subjective judgment from experts to understand whether or not we make a move here. Does something classify as high risk or medium risk or low risk? And so those programs have been fine to get us where we are in refining today, which is operating much more effectively than we have in the past. But to get from today's levels to future levels where, say, the PBFs of the world are trying to capture these $100 million cost bogeys out there, you need to be much more deliberate, much more data-driven, much more rigorous and system-driven, not just all the way down to individual pieces of equipment. And like I said, it might sound a little boring to imagine that something as simple as that can lead to hundreds of millions of dollars of savings annually. But it's true, and it's often overlooked, and it definitely doesn't get executive level attention as often as it should. And that's one of the big reasons, to write this kind of analysis and share it here on YouTube. And this is how we talk to our customers. And it matters what this work is, and these kinds of cost savings that capture make energy more affordable across the U.S. And that's a very important goal that we know we're pursuing when we work with any of our customers to try to capture this cost base. So it's analysis I want to share because it matters to the world, it matters to this country. It's the kind of analysis that's often overlooked. Like I said, it doesn't get the senior level executive attention that it probably deserves. But something as simple as this can lead to hundreds of millions of dollars of gains. So it doesn't always have to be some exotic new technology and new patent, a new way of doing business, and whole rethinking of how we execute inside of petroleum refining. It can be as simple as what we inspect, how we inspect it, what we choose to intervene in, what these maintenance plans look like, and that alone could help PBF capture $100 million or more, believe it or not. So thanks a bunch for watching and listening. If you like the video, please click the like button, click subscribe, and we'll do this again soon. Thanks a bunch.